Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's February 16th, Thursday, 2023, after the market close. Well, we've been talking about this. Which way is the market going to travel the next couple of weeks? How are we in a bear market rally? And what is the traders going to do and the sentiment that's going to develop? So we're going to cover that today. We're going to look at a couple of things. And first of all, you want to go to my website. That's the number 2, mestocks.com. So the number 2, mestocks.com. There we'll post videos on the front page, newsletter on the front page. You pull that down, you can see what's happening and what's going on. And in addition to that, on that page, you can, or other places on the website, you can sign up for our, weekly and daily alerts, right? That's the most important part because you get real-time trades right sent to you. All right, so what's happening in the market? I want to give you a quick update and more importantly, what's going to happen next, right? So the PPI came out and the producer price index rose 0.7% in January, higher than the 0.4 estimate. Here we are. The CPI was high. The jobs number was high. Now the PPI is higher than expected. Just commentary section here. Number one, we've got a lot of intelligent people gathering this data and reading it and reporting it. Why are they so wrong? Why are they so far off? That's question number one. If you go under the covers a little bit more, you see that. Look at this data on a quarter. If you look every quarter, there's kind of one month that's higher than or lower than all the rest. You look back, December, a lot of holidays, a lot of vacations. There's a lag factor there of collecting some of that data, and it gets finally smoothed in. So things that we probably should have saw in December gets pushed in January. If February we see a revision, that'll be interesting. But anyways, with that said, bottom line, like we've been talking, ad nauseum. Inflation's here to stay. It's not going anywhere. Yeah, it's from not 10% anymore, but it's still 6%. Nobody's in the mood for the prices that are being paid out there, and it is going to affect the economy. Now the Fed stepped up and they said there's too much. Basically they're saying there's too much euphoria. The people aren't getting it. The market is really not listening to us. So James Bullard, who's the Federal Reserve President of St. Louis, he came out and he's one of the speakers in between meetings that Powell uses to kind of get the message out. He said, I wanted a 50 basis point hike, not 0.25 last meeting. And also Loretta Meister, she's the Cleveland Fed president. She came out and said, yes, I wanted it as well. And on top of that, Bullard said, I would expect March, we're going to look at a 0.5 rate increase, not 0.25. So that really showered the CPI, the PPI. Markets opened down. Everybody bought up. They've been buying the dip, and they raced back up. And then these folks announced some sentiment, and we got the sell-off at the end of the day. So that's telling us the people were swooping in and buying it in the morning. They're also swooping in and buying at the end of the day, and then that's all been reversed now. We're going to see selling at the end of the day. That typically means further selling in the next several days. How volatile the market becomes will tell us, if we're going to be a deeper sell-off. If we bounce up and down very erratically in volume and the volatility picks up, then we're going to probably see those last lows in December. So, hopefully we won't get there. So the test is underway. Is it going to be sideways or is it direction headed? A couple of things I like to look at, but I look at them more in a weekly, longer trend. But let's look day to day. Advanced decline. You hear me talk about that a lot. We are the last bear market. We were up at these levels, and then we sold off and cascaded down to new lows. So we're in this bear market rally. Had some peaks. The RSI is down to 55 from 66. The MACD is really starting to the fast cross below the slow. It's on negative trajectory. We're not below zero. We're not into negative territory, but it's dropping pretty quick. That's hard to do when you have that many stocks in the New York Stock Exchange to represent. So for that line to drop that fast, that we could potentially have trouble ahead. But I look, so to kind of interpret a little bit more, since we're looking at it on a daily basis, I look at all the stocks in the New York Stock Exchange that are trading above our magical 200 EMA. Well, it only came to 67 today, so that's not too bad. It was 66, and then it was in the low 70s the week before. So that's telling us, and of course, the sell-off at the end of the day, that's really where we saw some drops. But that's telling you that stocks are still holding their pricing, if you will. But the MACD, again, rapidly dropping down, heading towards zero. That's not good. RSI on that is 57.5, 57.7. So, still a little bit of selling ahead. So let's look at the charts. Let's look at the SPY daily chart. All right, what is that telling us? We talk about technical trading, right? Technical indicators. If under the Twomey stock market report, we'd like to take a third profit after we've had a long run once we start hitting somewhere between the 9 and 14 EMA. So you'd be taking a third profit here. And then on the top of that, once we put another stop right below near the 20 EMA, we'd probably take another third off there if it goes there, protecting that run up that we've had. So we're getting out, not at the top, but we're preserving capital. If it races above that and we get back in and we lose a percentage point or two, not bad. Because why? Because when the market drops, it drops 5, 6, 7%. You wake up overnight, it's already down 3%. It's really difficult to get out. And then the fear factor goes, oh, it's dropped enough, I'm going to hold it. And then the next thing you know, you're down 12%. So we use the stops to help us. And yeah, once it reignites, we may lose a little bit, but we'll jump back in. And, right now, we're looking at, will the SPY hold at the 200, which is a big drop. We're at, closed at 409, it's 400. That's a pretty good drop. Will it hold like the diamonds or the Dow Jones? And we use the diamonds ETF as a proxy. Look at that. It's been sideways in a narrow trading range, but wide, right? We're looking at somewhere between, 330 to 344. So a good range there, but the 50 has been a good area where it rebounds from really for a month and a half, maybe 2 months now. So if we look at the 50 is looming really close on this, so we're letting our lower beta and our dividend plays have a little bit longer run, and our stops aren't as tight because we're going to really try to ride that sideways momentum until we get a major trend change. And if we can break out positive, we'll be in great shape. That's the premise, right? So that's our, we don't want to get to the point where our premise takes over from the logic, right? And then we're trading off our bias. Yes, our bias and our sentiment is to be long. Add on low days. Add in the morning and ride that up into the end of the day and try to get momentum that way started after you've gotten your core position. So that's our premise. That's our bias. We do feel that rates are not coming down, and we do anticipate that if you elongate the trend that economically and fundamentally we're seeing, inflation's here for a while, and I think the stimulus dollars will eventually run out, that the government spending, not short term, but we're going to get more of a slow economic growth. We're going to have jobs start to be affected, and we're going to kind of stagnate this economy versus grow the economy. So that's our, will it happen? We don't know. So we're following the technical trends now, using our third policy to hold. If we look at the NASDAQ that we use for, the high-tech sector, that's really been running high since the first of the year. That's pulled back, and it's holding pretty good. It's, compared to the Dow, is heading for its 50 EMA. This is not even, it just closed right below the 9 EMA. So, here we're starting into the first third territory. We haven't taken it yet, but we're very close. Tomorrow we'll probably get our first third taken off the table. return on, maintain those profits. We expect it's going to run down to about the 200 EMA. And will it hold? If it gets that low, it's going to be a tough test. In the past, it has not been a place for the prices to hold. They tend to race, see that, and run right through that. That's been the norm of stocks in the high-tech sector. Will it happen and continue? We need to wait and see. If we do break below that, we're probably going to get back to the December lows again. And that would really take a lot of heart out of this run-up. And if people see that everything that they invested in evaporated, I think there'll be trouble in paradise, right? Because the sentiment will be very, very negative. So we need to worry about that. Right now, we're going to be, we look at tightening some of our stops, which we did. We'll send those out by email. We also went to the TBT, inverse of the TLT. This is the, if yields rise on bonds, and of course this is a 2-to-1, goes up a dollar for the day, it gets 200%. These are leveraged fund. You got to really, if you trade them, they're not things that you want to hold for a long time, and they've got some really decay factors in the algorithm, so read up on that. It's very important. But, we are seeing yields rise, and we're going to see, and sure enough, no surprise, TBT's taken off for us. So, if it gets down to somewhere around 29.5, I would be adding, and substantially. So we'll see how along that rides, and we certainly know, interest rates are going to come up, and if they ever rise up 1.5 in March, we're going to have a lot of selling. So we want to protect our profits when we can. If we look so that's up 6.7 since our February 8th entry. Surprising, small caps are holding 6.88. We're holding that. We don't have a sell signal on that. High tech's dropped down. XLK 9.9. We're getting near our first stop there. Annaly Capital, that's our dividend play of 15.9%. That's minus 1.5. Not too worried about that. MGM Resorts, that sector is just on fire. That's up at almost 17. The interesting is the industrial ETF we play, XLI, that represents the industrial side, which is part of that consumer discretionary run-up that we've seen. That on a sell-off usually drops really lock and stock with the Dow Jones and the SPY, but it's held at 1.5%. So from when we got in, and we didn't get in at the best time, 98, 99 was the time to get in. So we got in at 100.78. We're a little late on that one. So that's interesting for that to hold. And also the XLB, the material sector down here, that's holding. So that's that lock and stock with what we're seeing in the Dow. And if the SPY can also go sideways, I think that'll be very positive for the market. BorgWarner, help with that consumer discretionary play, is up 19.2%. That one, BorgWarner, we're near almost the highs back in February of 2022. And this is the daily. I'm going to go to the weekly on this one because you can see 2022, there's the high. And we just nudged up against it. So it may pull back. I would be a buyer if it gets down into 46.5, 45.5 to 46.5. I would be a buyer and add to that position. BorgWarner has the opportunity to keep running in this market. And it seems to have defied all the interest rate issues. Plains, our energy play with dividends, Plains America, that's piping and natural gas, oil delivery out there, infrastructure too. So 7.2% dividend, that's remaining at 11%. The JP Morgan is a different one that is a different sector, but that runs at 11.5%. We're holding that. That's at minus 0.5. And then our tech play, analog devices, advanced, excuse me, that was the hot one today. Advanced micro devices. We're getting near, I believe we got our first, we had our first 1/3. We broke up everything up into another third. I have to look at the charts if we actually hit that 1/3 stop. And then we'll take it from there. And then the Other, dividend plays were at 6% and -1% almost on the other one. We're holding those. And our ETF, our mutual funds, no surprise. S&P came down, the tech sector came down, but they're still running positive. We got into the Parnassus Core Equity Fund this week. That is down 1% from where we bought in. It is a high dividend yield type stocks, more in a very low beta sector. Looking at that, if the market kind of pulls back a little to still give us good dividends and not too much of a negative return if the market pulls back. So that's what we're holding there. And, the best step for you out there is to reach me at info@twomeystocks.com. Email me a question. I'll get right back to you. In addition to that, if you want to go to our website, you'll see what's our latest videos and market reports, and you can sign up for any alerts, and we'll be happy to get those out to you real time. I am James Twomey. Today's the 16th. Tomorrow, Friday, could be a rocky day and some selling, so be prepared to snatch up some profits and then any areas that we see that are really opportunistic, we'll let you know. And, these high-flying NASDAQ stocks, they're still off 70% from some of them from their, highs of 2022. Just be careful. I mean, they've been on a rocket ride. They're also going to come back pretty fast and get hit pretty fast because profit taking will be there. But for now, we're still bullish, and we're going to hold, and we're going to see if our stops technically fire off. If they do, we're going to retain some profit, and then before we get to sell signal, we'll have opportunities to buy back in. I'm James Twomey. Have a great day.